DeepSeek's news is big. While Trump wants to stop China from being a tech giant, they are doing just that. For a little perspective, what took Google and OpenAI years and billions of dollars to do, DeepSeek did it in 2 months with dumbed down GPUs and with less than $6 million. Basically, what this has done in simple is disrupt the American tech companies. Anything that will make an investor question why so much money, why so much time, is generally not a good thing for investment. Sure, competition is a good thing, and it does drive innovation and investment, but this discrepancy in money and time is obviously concerning. Another thing that is affecting the markets is Trump's tariffs. Yesterday or Friday, Trump's people came out and said the tariffs on Canada, Mexico, and China will take effect today, the 1st of February, 2025, hence the sell-off we saw yesterday. So with all that said, let's get into the stuff that you follow me for. Though, as you can see here on the daily time frame, Bitcoin is still trading above and closing above its daily 21 exponential moving average. Even though there was a pretty sizable sell-off yesterday, it wasn't really that great. If we look also on the RSI, we can see that we were trading up into the 60 on the RSI. The 60 on the RSI just means that there is bullish continuation or the markets are extremely strong. So we generally want to see Bitcoin close dailies above this level as it's more of a buy signal than it is a sell signal. Even though we've lost that bullish momentum at the 60 up here, that doesn't mean we're bearish. Today is the 1st of February. That means yesterday we closed an all-time high month close. Is this time to start looking for bearish trades? Well, of course we can start to look for bearish trades, but we're not all out bearish. It's okay if we want to hedge our long portfolio. So a way to do that is simple. We will watch specific levels. Now, on the levels that I currently have, there are a lot of them. You can see that we essentially rejected at the high day close on Bitcoin on Thursday. Now, we also rejected specifically at the high day close yesterday on the S&P 500 as well. The high day close is the highest daily close of all time, so it is an area for profit taking to take place. Now, the markets move on orders coming in every second of every day. That is what drives near-term price action. So even if we do see big bearish candles, it doesn't necessarily mean that's going to be the sentiment moving forward in time. So we're not going to get super emotional just yet, but we can position smartly. A couple of the levels that I am going to be watching for potential bearish scalps, because if it is going to be the top, then the scalps can turn into bigger positions over time. The near-term daily time frame, we're still closing dailies above the 50 on the RSI, which does indicate more bullish pressure than bearish. We are still closing dailies above this. So with that being said, the levels will be the high month close, obviously, which is going to be right here at 102,411. We've got the weekly open, which is just above it at 102,555, and then daily supply up here at 103,710. We go into the weekly time frame, you can see we're still bullish on the RSI. There's no point in looking at that on a weekly time frame. The last 3 weeks, Bitcoin has advanced above weekly resistance or the high week close, but has not been able to close a weekly above it. So it does show us that there just isn't as much demand above 104,476 as one would want to see, bullish momentum or bullish continuation. We've been in this range since November, Monday the 18th. This is a 10-week range, and we're about to close the 11th. But this is not a hugely bearish candle. One thing to take of note, we did take out last week's low, but since we're in this range, it doesn't really matter. It's not like a huge signal. Now, a bearish close under last week's low would probably be a little bit worse, as you only have today and tomorrow left for that weekly close. So if you were to close under last week's low, then it would look a little bit more bearish, but still you're well above the yearly opening range, well above everything. That is a bullish signal. I don't understand the amount of bearishness that is out there, literally. All right, so let's go ahead and look at the S&P 500. All right, so once again, yesterday we traded up to the high day close, which was just made January the 23rd. We're 1 week out from when we made the high day close. Yesterday, we retested that level, and then the bad news came out about Trump tariffs, and then the market rejected. All right, so next week's high expected top edge of the expected move would be 61.44, and then the low edge of next week's expected move would be 59.36. There is a 104 point move expected for next week. All right, still above the 21 on the daily. This is a lower high, and that is a pretty sizable move, but it's not super bearish. If we lose this trend line, then one could be a little bit more bearish, because then you would be under the daily 21 and you would be under the RSI 50. The reason I'm not getting all out bearish just yet, even though this does look like a liquidity run, I'm not like buying into that just yet. It's because of all of these shorts that were stuck. They're still stuck. Stuck shorts is what can cause massive bullish rips. I don't know if we're going to get that either. I'm not saying that I'm expecting just straight up price forever. So moving forward, basically, I'm going to be just looking at next week, probably on the near term, looking for daily scalps lower, because if we are going to see that expansion lower to set the monthly low, then I want to see it be bearish next week. Now, with that being said, if that does take place, then that doesn't mean that I have a bearish bias, right? I have a bullish bias. I'm just looking for next week to be bearish, so that way I could say, yeah, we've set a nice monthly low. And a potential place to look for that, 59.50. So we can go back into the daily time frame and see where is 59.50. It's right here. Comes right in line with next week's low edge of the expected move. So this would be an opportunity to be a buyer if we do in fact stop down here. If we just blast through this area, then obviously I will be a little bit more hesitant. But if it does come down to this point and stop, this would be an area to look for buying opportunities, in my opinion. Keep these shorts stuck and then watch price expand much higher up into the 63 area. So that's kind of what I'm looking for. VIX over here still looking good. The DXY. Now, this trend was clean, right? So this breakout above, in my opinion, is just a liquidity run. But I will go into the next day that we have on Monday looking for another short entry, potentially at Friday's high, because if we get a wick above Friday's high and then we reject back under the yearly opening range, then this is going to be a bull trap. But if we get a candle that looks something like this, then that's no longer a bull trap. If this trend is going to remain a trend, then I want to see a very quick rejection. Now, with that being said, if we have something that looks like this, well, then I think that the trap is no longer set. No, the answer is no, because then we could get another run up and then a drop, right? These traps don't always take place in just one day. It can take a couple days to set up the short. But remember, if we see bullish continuation on an intraday basis above this price, then we've got issues, because there's potential for continuation higher. And that would be more bearish, in my opinion. Because if the dollar continues to run up, it's going to cause the bonds to go lower. And if the bonds continue to go lower, then the Fed is going to have some issues with further rate cuts. Fed definitely wants to see the 2-year yield roll over and get back in line with their target rate. So if we go look at this on a monthly basis real fast, just to kind of show you what I mean, if you type in the Fed fund rate and look at that, you can clearly see that the Fed fund rate does a real good job of following the 2-year yield. Usually the 2-year yield will make its move first. You can see the top came in here. The Fed still hiked rates, kept the rate steady at a 2.39. And then you had 1, 2, 3, 4, 5 months of downside on the yield. And then the Fed decided to start cutting interest rates again. So basically here we are. We set in a lower high on the 2-year yield, and then we get an expansion lower, which was a nice expansion, taking out support, going lower, and then the Fed started to cut. Boom, boom. Now the Fed has paused because this is no longer going lower. It's spiked higher. So as long as this higher spike here is up at this area, then the Fed has to pause. Everybody's waiting for the March. In my opinion, I don't think you're going to see the Fed do anything in March. I think the Fed will continue to be sideways until this starts to show something like this. Then the Fed will cut. Now, obviously, I am not a macro analyst. I could be completely wrong. I'm just looking at the charts here. But if you look at the charts, you can make a fair assessment that that is probably what is taking place. Let's go look at the 2-year bond, because this is what you would be trading. This was that non-farm payrolls that we got in January. We will have a new NFP this week, but you can see how the bonds use that NFP print to run these lows down here. And since these lows were ran, it went straight back up, retested the yearly opening range, rejected for over a week, before finally getting the breakout above the yearly opening range, and has been building in support here. So if this support holds and we get another expansion higher, then that's going to help the 2-year yield roll over and thus help the Fed continue to potentially cut. Now, I might look to put in maybe another long position, since we have traded sideways all week. Maybe if we get another retest of 102, I probably should have done it on Friday, to be honest with you. But I will be watching this moving forward. This is going to affect my decision-making process. We want to see this continue to trend lower. But we've had 1, 2, 3, 4 months of a spike and what looks like distribution. As long as this distribution continues, then we should see that expansion lower. Now, if we get a big breakout, that's going to be troublesome. This is also why I'm looking for the dollar to roll over, right? Everything looks good for that. You've put enough time in here of climbing to basically make the entire marketplace bearish. Like, you've set them up perfectly. I'm talking about bearish on the risk markets and bullish on the dollar and bullish on this, right? They're bullish on all this, on this, because of this spike, because of the dollar, because of everything, right? But if you look at it, it definitely looks like everything is still heading in the right direction. This looks like just a near-term spike, a near-term correction phase, a distribution period to allow more and more people to accumulate more of those bonds. But obviously, macro conditions will determine whether or not people buy the bonds. So it's just watch the chart. The chart will tell you what's going on. And as of right now, everything looks really, really good. Now, if we go look at the final thing, the ratios here, they look okay. I mean, they look good. We've gotten a period of a couple weeks correction, but there's nothing bad here. So it's rolled over, right? It's made a top. When will I look at this and become bearish? Well, this is a systematic correction. I mean, if you fib this range, you're still roughly just like around the 618 of this expansion. I would want to see a violent move lower, like over here. Once you started, this wasn't that violent. It was this stuff right in here. Violence, the volatility of the move lower is what's going to give me that bias of whether or not I need to be more cautious or not moving forward. But as of right now, this is not a violent correction. We had a violent little pullback on oil, or a spike on oil. That also affected inflation numbers a little bit because of that oil spike. Remember, every $10 move in oil on the price of a barrel of oil, every $10 move will cause inflation to go up 0.2%. 0.2. So that spike that we did see in oil would obviously affected inflation. But Trump likes to say drill baby drill, so that's probably ultimately going to be more bearish on oil. With all that being said, you guys have a fantastic rest of your day. Make sure you guys trade safe, trade smart, and as always, happy trading, everybody.